So what is distribution planning? What am I talking about? Well, the definition is retirement distribution planning is the process of determining retirement income goals and the actions and decisions necessary to achieve these goals. This includes identifying your sources of income, estimating what your cash flow, your expenses are monthly, and then implementing a program and managing those assets and risk. Future cash flows, which you're going to spend in the future, are estimated to determine if the retirement income goal will be reached. That's what retirement distribution planning is. There are 3 buckets, as I mentioned. And the idea is that ideally accumulating the right amount of assets in each bucket will help you protect you against rising tax rates. So what you need to start thinking about now is, what's in your taxable bucket? What's a taxable bucket? Taxable accounts are single accounts, joint accounts, trust accounts, any account that isn't in a tax-free account or any account that isn't a tax-deferred account is a taxable account. That love letter you get every year from the IRS called the 1099 is generated on taxable accounts each year. So calculate how much you have in taxable accounts. The second bucket that you need to be aware of, and it's probably it's the most important bucket that you need to be aware of, is your tax-deferred assets. Because tax-deferred assets in a rising tax rate environment are going to cause you more taxation in the future. So your tax-deferred assets are your IRAs, your 401ks, any retirement plan you have, 403b, 457, individual 401k. So add up all your sources of tax-deferred income, and that's your second bucket. And your third bucket, and strangely, and maybe not so strangely because it's sort of set up this way, is 90% of people watching this video, I'm going to go ahead and make a prediction, have the least amount of money in this bucket. What is this bucket? Any Roth IRA, any Roth 401k is tax-free. And any properly structured life insurance policy can be tax-free. Those are the only 2 investments that are truly tax-free, and they fit in that bucket. So how much do you have in your taxable bucket? How much do you have in your tax-deferred bucket? How much do you have in your tax-free bucket? Hold those numbers, and we're going to move forward. So it really depends on where you see taxes going, right? If they're going up, then you'd want to be in a Roth IRA or an account that does not cause taxation, clearly, right? If tax rates go from 30% to 40%, you want to be in the future in an account that doesn't cause taxation upon distribution. If taxes are going lower, then you want to put as much money you can into tax-deferred accounts today at a higher tax rate, because when you take the money out of the tax-deferred account, tax rates will be lower. If tax rates stay the same, either a Roth or a traditional works. So it really comes down to what you think is happening. And based on the data, it's pretty clear that tax rates have to go higher. In 2026, we know that they're going higher. So says the sunset provision. So in this section, you have learned that there are 3 buckets and that you need to begin to identify which buckets your money are currently sitting in or invested in. And with that information, you can begin to develop a strategy to avoid paying Uncle Sam way too much in the future.